Hello, I'm Pat Roberts, Managing Director of LNG Worldwide Consulting, and I'm producing this podcast in collaboration with the World LNG and Gas Series. And the theme this week is next steps in LNG pricing. There are three big changes which could be about to happen in Europe, as the European Union is expected next week to announce proposals to do three things they've never done before. The first is to launch a joint gas buying initiative in the European Union. The second is to develop an alternative gas price benchmark for LNG. And the third is to try to resolve their differences on whether or not to impose a price cap on gas imports. Collectively, these three changes will be designed to curb gas prices and to prevent rationing as much as possible. There is, in fact, also a fourth change which is under discussion, which is designed to redistribute wealth to manage overall energy costs. And that's a consideration of applying windfall taxes on companies which are profiting from electricity generation from nuclear renewables where costs are very low. Overall, the EU is developing an extremely complex supply, demand and pricing dynamic for gas, and it needs to try to resolve quickly the pricing spikes, the volatility and the illiquidity in the market. The decision makers are principally politicians from all the member states, whose countries are being impacted in very different ways as a result of the Russia-Ukraine crisis. Let's start with the joint gas buying. The intention is quite clear. It's to prevent countries from competing amongst themselves to buy gas. And Germany and the Netherlands have already said that they are supportive of the initiative. With regards to an alternative price benchmark, Brussels say that a new index is needed since the main TTF benchmark is guided by pipeline supply and no longer representative of a market that includes much more LNG. LNG, in fact, is on track to be about 130 million tonnes of imports into Europe this year, up 50 million tonnes from 2021. And in my view, that's going to be even higher in 2023. Several LNG traders have been saying for months that TTF market is broken for spot LNG trading. During the year, physical cargoes of LNG have priced at times at TTF minus $25 per MBTU, as LNG importers have been scrambling for available regas slots. And the differentials between TTF and MBP have moved on a daily basis, and at times have been minus $25 to plus $10, as pipeline distribution bottlenecks have prevented the free flow of gas between the continent and the UK. And remember that before the crisis, these differentials were more like about 20 or 30 cents per MMBTU. Asian LNG buyers are watching all these developments in Europe very carefully, as for the most of the year they've been outbid by European spot buyers, and rising prices and extreme volatility have made several Asian buyers retreat. The price cap, though, on gas on all the imports is causing a lot more division between members. From a pure economic standpoint, price caps use subsidies to manage prices and don't fundamentally change the demand management. And of course, price caps on imports could mean that LNG selectively goes to other markets. But it's complicated. We're dealing with politics here and not just economics. And some type of price cap is expected, though it's unclear how uniform it's going to be and how quickly it's going to be adopted. So stay tuned to our LNG wrap to see what unfolds next week. It could be the start of a brand new phase for gas and LNG pricing in Europe. On now to big company news, and the week belonged really to Tokyo Gas and MidOcean, the new subsidiary US private equity firm EIG. They announced a $2.15 billion deal where Tokyo Gas will sell its minority stakes in 5% of Pluto, 1% in Gorgon, 1.575% in Ichthus, and 1.25% in Queensland Curtis LNG. The move for Tokyo Gas to exit its gas ventures is driven partly by the need to cut emissions and is part of their Compass 2030 initiative to redirect their resources into new growth assets. The move for EIG is to build a high-quality, pure-play LNG company. If it all goes ahead, the acquisition will allow Mid-Ocean to secure about 1 million tonnes per annum of LNG for its portfolio. Tokyo Gas has said the deal has no impact on their own LNG procurement. Tokyo Gas also said, though, that the deal is subject to future approval by the Australian government and that there are multiple conditions in the contract with each project partner that, if not met, may prevent the sale of all or part of the projects to Mid-Ocean. Tokyo Gas also owns a stake of about 3% in Santos's Darwin LNG project, but that's not included in the sale. 4 Australian LNG ventures will now have to consider the implications of having EIG as a partner and their alternative preemptive rights options. This is a bold move by EIG and Mid-Ocean, who clearly see LNG as a long-term strategic transition fuel, and they will be looking at more investments globally. LNG stats and trends next, and I draw your attention to 2 publications, one out in the market now and one soon to be published. The first is the Global Voice of Gas, Volume 2, available to download from the IGU website, full of interesting information. And the second is the IEA's World Energy Outlook, which is going to be published on the 27th of October. On now to prospective projects, and Kepler Analytics are showing that the British sponsor vessel is approaching Coral FLNG and scheduled to load on the 16th of October. This will be the first cargo from the Mozambique FLNG Coral project. East Asia is looking as the possible destination. But, again, wait for another update from the LNG wrap on that perhaps next week. And over in the Arctic, Novatek has announced that it expects Obsky LNG to be developed to produce 2 times 2.5 MTPA LNG trains. It's changed its ideas, it seems, from building a chemical complex solely to now perhaps chemical and LNG. The location is the River Ob in the Arctic in the Yamal-Nenets region. Now on to LNG demand, and ConocoPhillips, ENOS and RWE have all booked long-term capacity at the 8 BCMA onshore Brunsbüttel terminal in Germany. This terminal is subject to final permitting, but is expected to be approved and expected to be online in 2026. RWE has a 40% stake in the project. Shell had previously signed an MOU for long-term capacity, but hasn't been mentioned in this last piece of news in terms of progression of those bookings. Another piece of news on LNG demand, which was in the news this week, is saying that China's LNG importers will not compete in the spot market this winter. If that is true, then it certainly is met with some relief that will help stabilise the short-term supply-demand dynamic. China's total imports are expected to be down significantly this year, and in fact their first major decline since 2006. Various consultancies, JLC, ICIS and Rystad Energy, have projected China's total imports for 2022 to be in a range of about 65 to 67 million tonnes. If you remember last year, China recorded around 80 million tonnes of LNG imports, so down significantly. And talking of down significantly, there has been a fall in the week in prices. So let's go now to short-term dynamics. And November JKM, $34.90, TTF, $44, Henry Hub for November, $6.44, and Brent at around $92.90 per barrel. But the news in the week really related to spot vessels, which are now close to $400,000 a day, a level usually reserved for ultra-deep water drilling ships. Most dual-fueled ships have now switched back to very low sulfur fuel oil bunkers, which are currently costing about 1/6 of the cost of gas. It's been projected that vessels could actually rise in their daily levels from here still, so watch this one, but these are unprecedented levels we just have never seen before. So that's it for my LNG wrap, and I hope you've enjoyed the episode. We do invite you to rate it, to review it, and to subscribe to our LNG wrap. And we really hope that by doing this, it will help others to find us. Thank you very much for joining us. Join me again next week for what happens next. Thank you and goodbye.